It was the blunt but ingenious billionaire Kerry Packer who memorably explained to a stunned parliamentary committee exactly how the tax system works. The late business tycoon said, "I'm not evading tax in any way, shape or form. Now, of course, I'm minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads read, because as a government I can tell you you're not spending it that well that we should be donating any extra." Now, this classic summary of how things really work on the ground is just as accurate today as it was 33 years ago, and it'll probably remain accurate for many decades to come. So have you ever wondered how the wealthy seem to pay less tax than the average person? Well, my guest today is accountant Alan Mason, who was Kerry Packer's former accountant, and he's the author of the book The Tax Secrets of the Rich. Our discussion today will be critical for all business people, but if you're a property investor, you are in the business of providing rental accommodation. So let's find out the tax secrets the tax office doesn't want you to know about.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Is it true that the wealthy always pay less tax than the average person? Well, it seems to be the case, but my guest today, accountant Alan Mason, shares his 40 years of tax and accounting knowledge in his updated book, The Tax Secrets of the Rich. As the saying goes, there are only two things certain in life, death and taxes. Or maybe just one of those is true. You'll be the judge after my chat with Alan today. Welcome, Alan.
Thank you. Thank you, Michael.
Now, Alan, congratulations on the updated version of your bestseller, Tax Secrets of the Rich. But before we delve into how to reduce our tax legally, can you please maybe tell us a little bit more about you and why we should be paying attention to what you've got to say?
Yes, and I've been in practice over 40 years, but been around. I've seen it all. I've seen all the situations with high net worth people whose names you'd know. Kerry, of course, but a few others that are current clients that are on the news radar, if you like, from time to time. And there's a strategy that people like that think and the way that they do things. And it's probably a little different to what the mainstream media would tell you about. I've seen it all. I've got case studies. I've got people who have not listened to me and have done the wrong thing. I've got people that have saved a lot of money. I think I've been through every type of scenario that exists in the world of business, mainly because I've been in it for a couple of years.
Sure. Well, look, let me also give a disclaimer. This is not tax advice. We don't know your personal circumstances. Regular listeners of this show would know that Metropole has a wealth advisory service run by Ken Race, and we can give you personal advice, but that's not what the aim of this is about. And similarly, the great book that we're going to talk about, Tax Secrets of the Rich, is general and you're going to have to get your own personal advice. Now that I've actually got that disclaimer out of the way.
Out of the way. Well done.
Alan, I had to do that. I would like to ask you a question. What was Kerry Packer like to work for? Now, you and I are old enough to remember Kerry Packer. Most people know his son and all that's going on at the moment, but Kerry was quite a character in business, running the Channel 9 network and bringing in, what was that cricket, how he changed the face of cricket?
World Series cricket.
Yes, yeah, World Series cricket. So what was he like to work for?
I've got to say, I'm asked this question many times, very respectful. He was a quiet person in the office and would think, listen, and then he'd come at you with a torpedo or with okay, let's do it. So he was very considered and considerate. And many, many times, we'd come up with some ideas on how we do this or that. He'd listen, he'd get you to explain. You probably don't know he was dyslexic, so you tended to have to explain everything to him. And these are the times before computers. So you didn't have spreadsheets. You tended to do things manually. A different world, but Kerry was easy to work for, to be honest. Easy if you were part of the team. If you were not part of the team, well, forget it. You're out.
Well, you were advising one of Australia's richest people at the time. You still have very high net worth clients. So what do the rich know about paying tax, or maybe it's not paying tax, that the regular person doesn't?
I like that, Michael. I'm not paying tax. I mean, a lot of people say to me, is it true that the rich pay less tax than the average person? And frankly, on a basis of income, yes, it is true. You mentioned earlier there are only two things certain in life, death and taxes. I can tell you that, and with Kerry, it was, son, you need to be worth double what I'm paying you. And then that forces you to think and forces you to put on a mindset of how can I solve this problem? So it is true that the rich pay less tax than the average, up to a level. And once they get to earning, billions of dollars, they don't care anymore. They create their charities and foundations and push money into that. They get deductions for it, of course, but then they are able to channel their tax dollar that could have been tax dollar into benevolent type situations, which is what they tend to do.
Well, as Kerry Packer said, I can probably spend the money better than the government and the tax man can. What are some of the myths that the ordinary Australians believe about tax?
And maybe they're myths that the tax office wants you to believe. Things like, the more money I make, the more tax I pay. That's rubbish. It just means you've got a lazy advisor. You've just got to think about things. You've got to plan and not be on a back foot. This business of signing a tax return in the last minute, crazy. This business of having just been stuck with what the status quo is, it means you're not planning. You're not taking time to consider how that transaction should be structured. I mean, I've had many, many cases in my career where I've looked at something and I thought, I don't know what could be done here, but let's look. And I found a solution. I can't tell you that there's always going to be a solution, but many, many times I've been able to pull a rabbit out of the hat and solve a problem where other people have not. I had two cases just last year, in fact, where I was the third accountant that this client went to, the third. And all of them, and they rang me because of my book, all of them said, this is the situation. My accountant or next person I spoke to said, there's nothing we can do. I said, send me your information, send me the paperwork, and let's see what we can do. And I can tell you I fixed it. And I won't tell you how much I saved in both of those cases, but it was, for one person, it was life-changing because they could not have afforded the tax that would have applied had they not done something. It was simple. And I'll tell you the example of that one. It was a trust that had tax losses in it, that the trustee had gone into bankruptcy, and all the previous accountants said, all the tax losses are lost. But that's not the case. When a trust does not go into liquidation, I should say, not bankruptcy, liquidation. A trust does not go into liquidation, the trustee does. And the trust can continue, appoint a new trustee, use those tax losses going forward. And this was over 500,000 of tax losses that they could have lost. Two accountants said they couldn't do it. Maybe there's some poor advisors out there. Maybe there are a few people that the tax office have suppressed to a level that they're not prepared to challenge the system or the status quo, or look hard or try to find solutions.
So clearly you were able to help this client with tax issues. Many people who have family trusts don't even understand the importance of the various people in the trust. So you were mentioning the trustee can be changed, and so it's important to become the appointer. But again, this is not the right venue to give that sort of advice. I think the other thing we should mention is that we're not suggesting you should do anything illegal. You've got to do everything that's legal. But I recently interviewed the Assistant Commissioner of Taxation for this podcast, Alan, and I was amazed at the extensive data matching service the ATO has. It makes no sense to try and hide anything from them, does it?
It's exactly, and ill-advised to do so. If you've had a sale and a capital gain, you should report it. You have to report it. Or if you're renting a property, even now real estate agents have to report the rent that they receive, and the taxpayer just receives it. So you are ill-advised to not declare, and you're better advised to do it in the most tax-effective way. So be on the front foot. And I do have a chapter in my book about somebody that did do the wrong thing. Well, I've got quite a few case studies in my book about people that have done the wrong thing and how we've handled it, or people who have not declared and the pre-fill has picked it up. And let me say also, the pre-fill from the tax office, which is the data match, is not always correct. I've got a case at the moment, and I'm working with the tax office on an audit, and the pre-fill is not correct, and I've had to show them why it's not correct. But again, you've got to be on the front foot with these things. You cannot afford to just be a puppet on the tax office department's string.
I like the mindset, the attitude, and that's what's important, and that clearly comes across in your book as well. I regularly hear people saying, as you do, I'm paying too much tax. How do I reduce my tax? What advice would you have for them, of course, other than buying your book, which has got lots of great advice?
Exactly. Educate yourself. You need good advisors, firstly, people who are on your side. So, and to go back to Kerry Packer, if after 6 months you didn't work out, you're gone. You either got a big rise or the boot, one or the other. And so you need good advisors. And I can tell you out there, as a third of all accountants, and I think it'd be correct to say that you wouldn't feed. And how do I know that? Because those clients have come to me. And they've said, I don't have a person I can talk to, someone that speaks plain English, someone that I can relate to, or I can talk about my issues and come up with some ideas. That's very important. So if you're paying too much tax, and I can't tell you that in every case I can pull a rabbit out of the hat, and there are cases where I have not been able to do anything. It is what it is. But it doesn't hurt to look. It doesn't hurt to think. The other part is, Michael, often with a transaction, it doesn't happen overnight. The 30th of June might be a few months away, and something's happened. Maybe there are things you can do. Maybe you need to look back over your structure. Maybe either tailor the transaction a different way. This happened, in fact, with a sawmill, in the middle of purchasing. And we changed the transaction. It was a $6 million sale, and the person who was selling it worked out they're going to have to pay a heap of tax. I was involved with the buyer, the company I was involved with. We restructured the transaction, and we restructured it using merger and demerger rules, and something I mentioned in my book. So sometimes you can restructure a transaction to be tax effective, and don't think the tax office aren't out there to help you. Sometimes they will. Many cases, I've had a situation, I've rang them and spoke to and said, well, I just need to check this particular point. And they're more than willing. The tax office, they're people. They're normal people like you and I. Yes, they protect consolidated revenue, but many cases, I mentioned an audit I'm dealing with a tax auditor on that one. And I've said, look, the pre-fill's not right because of ABC. And he said, yeah, I know, we know that. Sorry about that. And I said, look, we've got to amend this tax return. And he said, yep, we understand, which is fine. So they're people. You've got to deal with it that way.
Now, your book's full of tax tips, but what are some of the top tax mistakes Australians make?
It varies on whether you're a worker or a business person. As a worker, I'd say 20% of workers don't claim enough in their tax, mainly because they're lazy. They don't pick up on expenses they've incurred in gaining or producing their income. They've gone and they've travelled, they've gone to courses, they've worked from home, and they haven't bothered to keep the right records to make the claims. And that's crazy.
Most people listening to this are property investors. They are business owners. They've got to think like business people. They've got to plan like business people. They're in the business of providing rental accommodation for Australians.
Which is an admirable cause, and we should support them. We shouldn't tax the hell out of them, to be honest, because that's our lifeblood. We need housing. We need these investors. So what should they be doing? Should be looking very hard at the structure, the place in which those properties are held. They need to have cascading abilities, cascading from trusts to various other trusts. If they've got losses in one area, they need to be able to combine those losses into that profit-making entity. They need to be able to plan in advance what that year is going to look like. So, for example, let's say they've sold a property in the 2024 year, and they've made a massive capital gain. And they'll get CGT discount, all that type of thing. But let's say there's got a tax bill of 50, 100 grand or something. Well, you can't go back and change the tax bill once you've gone past June 30. But you could, for instance, if you were holding a property that had a loss on it, you might think to yourself, well, maybe now's the time to offload that lost property to offset the capital gain on the other property. And you might do the same for shares. There are wash rules that affect shares, share buy and sells. But you might want to think about, well, maybe on this other property that I'm holding, I'll prepay a year's interest in advance, which will give me a bit of loss, which I can offset against that capital gain. Again, you're thinking ahead. Let's max out my super contributions, 27.5, and maybe there might be some unused caps from prior years. So I can max out a bit more, get a deduction for that, offset the capital gain. So don't leave it till the 30th of June or 1st of July and think, oh, I've got a big tax bill, what do I do? Look at it in advance. I already know in my situation what my taxable income will be for the 24 year. I do it from about March to June. I'm planning through, and I'm planning on what I'm going to do to move money around in different places, how I'm going to minimise what will be the result for that particular tax year. So planning is the key.
Now, I liked in your book that you also wrote about the survival of success, how to play and win, actually, the game of life. Could you share some money tips successful people use to create wealth or run their businesses, and also, I guess, how they get a better work-life balance?
And that's all about getting passive income, building up a portfolio that will not make you dependent upon a job, will not make you dependent upon an industry that might fall over and cause you to be unemployed and cause you stress. You need to, at an early age, start thinking about building a passive income lifestyle. One of my favourite chapters in the book is Rags to Riches. I've actually done that probably 3 or 4 times with clients and recommended it. And it's building up a massive, in this case, property portfolio, whether it be property, commercial or residential, or even a share portfolio, incrementally, slowly, over time, using the bank, using the tax refunds on depreciation and all those areas that you can max out, and building up an asset base. And I use the example starting at 10 mil, and can I tell you that example is a pretty accurate example of what people have done and do, and I've done, and I've recommended clients do, and those clients love me forever, because I can tell you someone got a portfolio of 16 million or more of assets that built up, and now they don't have the issue that if something happened in their business, they still have a passive income to survive on.
So really what we're talking about is building up passive residual income that you don't have to work for anymore, and your money's working for you even when you're asleep or away on holidays. And we're of the same philosophy that residential real estate is a great asset class to invest in, but it's not the only one, and I agree that one should have a bit of a balance of a number of asset classes. Interestingly, in your book, you say that 20% of Australians underclaim. What do you mean by that, Alan?
Because they're lazy. I think that because they're not good at record keeping.
Or is it they don't know what to claim?
Maybe, or maybe they're just not financially literate. They're good at what they do, but they're not good at keeping records and recording.
I think that's a really important point, isn't it? Because when the taxman comes in a couple of years and asks you why you've made a particular deduction, record keeping is critical, isn't it?
Exactly. You've got to be able to prove what you've claimed. And there are various record-keeping systems the tax office has. You've got to comply with it. Like, fringe benefit tax. You've got to have a logbook for your car, and it's got to be done correctly. You've got to fill it out correctly. I've had audits where the taxpayer hasn't done that correctly, and they've got stung. So record keeping is very, very important. The tax office goes at great pains to explain what those record keeping requirements are. They're listed. I've got them in my book, but they're listed out in great detail.
Now, in your book, you write about the millionaire mindset, something I very much agree with, as I believe a significant part of everyone's success is their mindset, what I call their wealth operating system. You probably know I've written an international best-selling book about this, actually called Rich Habits, Poor Habits. But I'd like to explore a little bit more about this with you. How do the wealthy and successful people think differently? How do they act differently to the average Australian, Alan?
In most cases, it's not accepting the status quo. It's questioning everything, research, checking, getting good advisors. An important aspect is that you might be good at building, construction, but there are things that you may not be good at. So you've got to get good advisors. You've got to learn to delegate, and you've got to get the right people on your team and delegate to them. So one of the main aspects of a high net worth person is they always think outside the square. They always follow their instinct and gut feeling. They need sometimes a little bit of quiet time to think about where they think things are heading and what they're comfortable with doing. And if someone comes up and says, "Oh, you're going to pay $1 million in tax," they go, "That's not really acceptable. I don't know if I can't want to do that. Come up with a solution. Let's work out what we can do." I've had situations where I've discussed it, and we've come up with a solution together. I've said, "Well, we could do this, we could do that. Let's have a look at this," and talk through and be respectful. Most high net worth people are respectful to their advisors. I can tell you that for a fact. And Kerry was the same. A few of the guys I work with now. One of his companies went into liquidation, and the liquidator said to me the guy was a pig to work for. And I said, "Well, actually, he's really great with me." but to other people, he wasn't very nice. So that's probably a bit funny. But
Wealthy people are prepared to pay for advice, Alan, while the average investor gets their advice for free on the internet, on social media. And I guess the most expensive advice is actually the wrong advice that you get for free.
That's exactly true. When you start Googling things, firstly, you don't know if it's going to be Australia, UK, or America. Sometimes it can be confusing. It's the first thing. And secondly, it may not apply to you. I get people say to me, "Oh, look, I've checked this and this is what it says." And I said, "No, that doesn't apply to you. This is not your situation." Or yours is a discretionary trust, not a unit trust. Or we've got a corporate entity, a company, not a sole trader. SBE may apply to you, may not apply to you, and all these other little variations. And it's only someone that's been around for a long time that has been through the mill a few times, more than once, that you kind of find out all these things, and you're able to contribute and help. And I do this all the time. As I said, in many cases I can pull a rabbit out of the hat, but not always. But let's try. Let's have a millionaire mindset that tries to find solutions, that will pay for advice, that will explore opportunities, explore variations, explore different roads, and then come up with a manner in which they wish to transact.
Sure. Well, successful people have a positive attitude. They believe they're in control of their life. They believe they're the pilot, not the passenger taken along for a ride. So they look for ways of making their lives better. I'm sure you're right that the mindset makes a huge difference in your success in all areas of your life. I think the more you feel in control, the happier you are as well, rather than feeling that others are in control of your life. Alan, in your book, you had a section on pay yourself first. You were suggesting that most people do it the wrong way round. What were you getting at?
A little bit about what you were talking about just now, that if you allow yourself to be a victim of the system, to be suppressed, to be a puppet on the tax office or someone else's string, you need to learn to be the puppeteer. You need to be at the top, not the bottom of the string. So pay yourself first means making sure that you don't have a poor lifestyle. You've got to be reasonable about it, but you've got to run this business for you. And you're the one putting all the hard yards in. You're the one that's taking the massive risk. So you need to be rewarded. And if things go against you, then you need to structure yourself in a way to get out of that as best as you can. And there are ways to do that. I've done that hundreds of times with clients where we might have dozens of companies in the group, and one of the companies gets into strife, and how we're going to handle that. It's a little bit complicated, and I probably won't go into too much on air here, but pay yourself first. Look after yourself.
Yep. Makes sense. Now, We mentioned a couple of times you've got to do things legally and correctly. There are some pretty significant penalties the tax office can impose on you. Can you maybe just have a quick chat about those?
And I do list them in my book, but basically, if you don't do the right thing and you don't handle it correctly, you could be up for double the tax that you've missed. You can also be recommended to the DPP for prosecution and get a criminal record. We all know the story, and I always laugh about Al Capone, mobster, killing people, doing all sorts of things. The only thing they pinged him on and put him to jail on was tax evasion, evasion. And that's the only thing they could get on him. They could get him on. So you've got to do things right. Now, if you've done the wrong thing and the tax office audits you, you need to come clean. You need to have the right advice. And of course, I've had situations where people come to us, but situations where they don't tell us everything. They're getting cash or something and they don't tell us about it. And then they get caught. And it's always a case of let's make a full and frank disclosure. Let's go back to the tax office and let's not try to hide. If you're getting audited, let's handle it correctly. And in my book, I mentioned 2 case studies. One where the person did not. They got fined over 100% of the tax that they avoided. They went to jail. Another case, similar situation. Both cases they received cash, had a business that received cash. The second case, the person disclosed it to me when they started to get audited. I said we need to disclose it to the tax office, which we did. We amended all the tax returns. We amended all the BASs that applied for that period. And the tax office at the interview said, is there anything you want to disclose? And I said, yes, well, there's this bank account they hadn't disclosed. We amended everything. Here's all the amended paperwork and BASs. And I slid it across the table to the auditor. She said to me, thank you. I knew all about that account. I knew that. Thank you for doing our work for us. We'll proceed. The end result of that audit was no penalties, no interest, no fines. We got all the remissions back and we applied for it, got them all back. So in that case, no issues at all. So you got to know when your time's up, you got to know when to call it quits, if you like, or make a full disclosure.
I guess over time, people build an asset base, they learn more, they build their businesses and grow, they've got a big property portfolio. And I've seen that sometimes they outgrow their initial advisors. And I think that's one of the messages I'm getting from your discussion and from your book, that you've actually got to have good advisors that think outside the box also. So you've also written another book about how to choose an accountant a while ago. What should an accountant be telling their clients?
You need to have an accountant that's close to you, that understands you and that understands the system. So there are many accountants out there that probably sausage factory type accountants. They have so much work that's just pushing the work through the door. They're late always. They're never spending quality time to understand the client's situation. So there are about 6 tips that I put in that book. And one of them is being computer literate. And you might think that sounds funny, but I can tell you how many accountants are not that IT savvy. Unbelievable. They'll say, I get my girls to do that or whatever. Well, that's okay, but you've got to understand and do it. So, they hide behind facades, and as I said earlier, there's probably a third of all accountants I wouldn't feed. The reason I know that is because those clients have come to me and I hear the bad stories. The ones that have got good accountants I don't hear because they stay with their accountant and the accountants are doing a good job. But it's the ones that change. And I mentioned earlier about 2 cases last year where I was the third accountant that person spoke to. And I discussed, I said, tell me about what your situation is. We had a bit of a talk, went through a number of things. I got them to email a few things. In one case, it was pretty complicated with about 10 different structures. And I said to the guy, look, I can fix this. I know how to fix this. And he said, right. And I said, I won't even charge you a fee. I'll only charge you on success. If I don't save you anything, it's free. And he said, done. And he shook my hand.
Fantastic.
So, you've got to think outside the box.
Great. Alan, that message has come through a couple of times, and it comes through your updated book, Tax Secrets of the Rich, by Kerry Packer's former accountant, Alan Mason. Where can people find your book, Alan?
We have a website, certainly bookshops, online, plus our website, alanmason.com.au, or all of my books are on my broadviewpublishing.com.au website. So either will take you to the
Well, I'll leave a link in the show notes so people will be able to find it rather than remembering it, because they're probably listening to us while they're at the gym or going for a walk or doing other things. Alan, congratulations on the updated version, which actually I know contains some updated with things with the latest tax changes. Thank you for your time and all the best with your book. I hope you help lots of Australians with it.
And thank you very much for the interview, Michael. Anyone that buys the book through our website, I'll autograph the copy.
Great.
So that it's an autographed copy. So at a bookshop, of course, I can't. But either way is fine. And if your listeners have any issues they want to discuss or talk about, happy if they want to reach out.
Well, I'll leave the link to your website in the show notes. Thanks for your time, Alan.
Thank you, Michael.
Well, that was an interesting chat with Alan Mason, and I guess the message was make sure you have the right advisors to help you legally minimise your tax. If you've got some benefits, but you're not currently a subscriber to this show, on whichever app you're listening to this, whether it's a podcast app or YouTube, where a lot of people listen to this, even though there's nothing to watch at the moment. We may be doing video podcasts in a short while. Why don't you stop for a second, subscribe, so twice a week you get information from my guests and me. So along the theme of what Alan was saying, you do need great tax advisors, and that's partly why at Metropole we don't start talking about a property until we've done a strategic plan, and that always includes a structure review to make sure you've got the right ownership structures moving forward. And we've also got access to the team at Metropole Wealth Advisory that provide tailored strategic wealth advice for clients as well. So property investment's a process, not just an event. You can't go off and just buy any property. Well, you can, but you can't be successful in that process. That's why, as Alan said also, the majority of investors never get past their first or second property, and we want you to get to that level. So at Metropole, we help you safely grow into generational wealth through strategic property and wealth advice. We're much, much more than a buyer's agent. We're big enough to tip the scales in your favour, but small enough to care. So if you want to understand how various services help you, and you may choose to use some or all or many of them, go to metropole.com.au. I'll leave a link in the show notes, and have a complimentary initial chat with one of our wealth strategists to see where you want to get to and if there's some way we can help you. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share a lesson with you that basically says the longer it takes, the longer it will last. Now, I got the concept of this chat from a blog by my good friend Tom Corley, who regularly writes a property update, and he's my co-author in the new book, Rich Habits, Poor Habits. Now, why I say new book is because we had the second edition just come out where we've updated it for the current financial markets. You can go look at that at richhabitspoorhabits.com. But Tom explained that the average red oak tree takes 15 to 20 years to produce its first acorn, but it will then go on to produce acorns for up to 350 years before that big red oak dies. Conversely, a cherry tree takes about 4 years to produce sweet cherries, but its longevity is short-lived. It'll produce cherries for only about 20 years before it dies. And Tom explained that becoming wealthy like the mighty red oak takes a long time. He did a study of self-made millionaires, his Rich Habits study, and he found that on average it took self-made millionaires between 12 and 32 years to become wealthy, depending upon the path that they used. They found different paths to become wealthy. But he said almost every self-made millionaire in Tom's Rich Habits study, other than the saver investors, shifted into wealth management mode once they became wealthy. They did everything within their power to preserve and grow their wealth long after they became wealthy. Not one of the self-made millionaires in his study squandered their wealth once they became wealthy. Not one? I've wondered about that, but apparently not. You see, the path to becoming wealthy is a long journey. The self-made millionaires in Tom's study understood how hard it was to accumulate their wealth, and because of their smart money mindset, I guess, that got them there, they intended the wealth that they created during their lifetime to go on long after they were dead, to create intergenerational wealth benefiting their children, their grandchildren, and their great-grandchildren. And I understand that. That's what I'm doing. See, these people in his study saw their wealth as an opportunity to benefit many future generations. That was their legacy. Conversely, according to the National Endowment of Financial Education, about 70% of all lottery winners go broke within a few years. You've heard that before too. Easy come, easy go. Because they didn't work on building their wealth over many years, the wealth really didn't have the value for them other than spending it or giving it away to their family and friends. So if your goal is to become wealthy and keep that wealth within your family, you must build a solid foundation, said Tom, forged with smart money habits forged over many years, which can then be passed on to your children. But building that sort of a foundation takes time. But the longer it takes, the more sound the foundation will be. So my question to you in my mindset message today is, which tree would you rather be? The cherry tree or the long-lived red oak tree? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?